Good morning, gold trader. Before we begin, stay until the end because there will be a short quiz based on today's breakdown. If you're serious about mastering gold price action, test yourself and comment your score. And if you value structured, no hype XAUUSD analysis every day, consider subscribing. Now let's address what happened yesterday. Gold sold off by nearly 5%. That's not normal volatility, that is aggressive repricing. When you see a move of that magnitude in a single session or a single trading day, it tells you one thing. Liquidity was engineered and aggressively taken. This was not random selling. This was stops getting cleared, positions getting unwound, and imbalances being created across multiple time frames. After a 5% move, today is not about chasing. Today is about understanding, was yesterday's move distribution or was it liquidity before continuation? Let's break it down properly. First thing we do is mark the previous day high and the previous day low. We move on to the day time frame. We use the magnet. This will be your previous day low and this will be your previous day high. After a 5% sell-off, yesterday's high becomes a very important liquidity level. Why? Because that high now represents trapped buyers, people who priced for the market to go up because there was a war. If prices retraces upwards today, the zone becomes a potential reaction point. Yesterday's low now represents fresh sell-side liquidity. If price continues lower and sweeps that low again, we must watch if it's exhaustion or a continuation. After a large range expansion day, PDH and PDL define whether today will be continuation or a retracement and rebalance. Big range days often lead to inside days or partial retracement days. So treat yesterday's range as your primary map for today. We now zoom out of the daily time frame, and a 5% sell-off almost guarantees new inefficiencies being created. So we look for fresh fair value gaps which were formed or thin liquidity zones. When markets move aggressively in one direction, they leave voids behind. Price does not like inefficiencies long term. So if a large daily imbalance formed during yesterday's sell-off, that becomes a magnet for retracement. But here is the key. In strong bearish momentum, imbalances above may not fill immediately. So the question becomes, is the daily structure broken or is this a pullback in a larger bullish trend? So the daily chart answers that. We can see if you draw the fib from the low to the high, if you consider this the previous low, you can see that the market has come to the 0.5 level and reacted. You can also see that there was a void and a bullish BC right here. So the market reacted to that. So let us now see if this serves as a continuation to the upside because it reacted to this level, right? So we mark this as a 1-day BC. We now drop to the 4-hour time frame. This is where yesterday's institutional activity becomes clear, right? So if you see yesterday's range, we can see that there were two CBs that were formed on the 4-hour chart. We can mark one here and another one here, right? 4-hour CB. So you mark every 4-hour imbalance formed during the sell-off, which was this. And these zones often act as retracement targets or a continuation supply zone. So if price retraces into a 4-hour bearish fair value gap and rejects with displacement that confirms a continuation lower, if price slices through it cleanly, that suggests that the sell-off was liquidity driven and not a sustained distribution. After aggressive days, 4-hour is where clarity forms. While we can see that there were 2 SIBIs that were formed during the previous trading day, this marks the beginning of the current trading day, and you can see that there's a void here, 4-hour void, which we will mark now, right? So this could act as a support for the market if it were to come down. So this would act as a support in case the market came down. So it could move like this, and each of these levels become very important to see if the price actually cuts through or if it reacts to it and then continues further down, right? So this is why the inefficiencies are important. We now move on to the 1-hour. After a 5% drop, there will be multiple equal highs from late sellers, micro equal lows from panic selling, and intraday inefficiencies. You can see multiple 1-hour SIBIs having formed. Right? You can see a very slight one having formed here. And another one here. So what we're doing here is marking all the inefficiencies that we can see in the market while the market moved down, right? I can see another one here, which is almost overlapping with the 4-hour SIBI. And let's look down further. You can see that there was a SIBI here, but the market has already repriced into it as this day opened. This was yesterday's SIBI, but today's movement has already rebalanced it. We can see another important aspect here, that being a void having formed on the 1-hour chart when today started, right? 1-hour void. And we can see multiple BISIs having formed on the way up. Another concept I want to introduce here is this was a very strong upside move where this candle formed without a wick. These are called wickless candles. These become very strong liquidity magnets when the market moves. So in essence, if we are trading near yesterday's low, that area becomes fragile. We are currently trading around the midpoint of yesterday, so we will still have to let the market show its hand. So the 1-hour time frame tells you whether today is corrective or impulsive. Look for displacement. No displacement is no trade, right? So the next thing that we consider is liquidity, liquid volume profiles, right? The volume profile shows you where there was maximum institutional activity, volume wise, at which prices there was maximum institutional activity. So we use the volume profiles to add the value area high, the point of control, and the value area low. After a massive sell-off, the POC becomes critical. So let us first mark yesterday's day, right? The day starts at 1800 and ends at 1600, which is where we've marked it. You now mark these levels. You can see that the value area low is overlapping with the previous day low, right? This is the previous day's value area low. You can see the purple line, which is the previous day's POC, around 5,116. Previous day's POC. We then mark the previous day's value area high. After a massive sell-off, like I said, the POC becomes critical. If price retraces towards the POC and rejects aggressively, that signals the continuation of bearish sentiment. You can see that the market has already priced through the previous day's POC. If the price reclaims POC and holds above the value area high, that signals the sell-off might have been overextended. So volume tells us whether yesterday's move was accepted or emotional. Price outside value and failing to re-enter means that the market might continue, while price back inside value and holding implies that the market is rebalancing. We then draw a fib between the PDH and PDL, which shows where the market attained equilibrium yesterday, right? 50% is equilibrium. After a strong bearish candle, if price retraces into the 50% level, which it has, and rejects, that's classic continuation behavior. So we consider yesterday's move as a bearish move, and will the market continue downward or move upward is what we are trying to gauge here, right? So if price pushes above 50% and accepts, that means it's a deeper retracement. So it doesn't mean if it goes beyond the 50%. Now let's say the market is moving up, and if it actually moves to this CB, right, it could only signal a deeper retracement rather than a continuation. So it could very well come back down to sweep the PDL. So on large range days, the 50% retracement becomes a high probability reaction level, where you can see that it has reacted once. So we will see how it reacts further. So buying below equilibrium in a bearish environment is risky. So at any of these levels, unless it has touched the 0.5, you do not consider a trade, right? Always measure where you are relative to equilibrium. So we now look at psychological levels around the current price. After a 5% drop, round numbers become even more reactive. Why? You can see that the market reacted to the 5,000 level yesterday when it sold off, right? That was not coincidental. That's how gold moves. So traders panic around these round numbers, which is why they're called psychological numbers. So stops are clustered here, profit targets sit here, reversals often form here, like you can see that the market did yesterday. If the psychological level overlaps with a 4-hour FVG or a fib 50%, PDH, PDL, or a volume level, there's a high probability confluence, and we can see that the previous day low and the value area low are overlapping at 5,000. So let us see what happens there. So what is today likely to do? After a 5% sell-off, often the market retraces 30 to 50%. It has already retraced to the 50% level here. or consolidate inside yesterday's range within these two extremes, right? Chasing continuation after a massive move is dangerous. It's already moved a lot. Is the market going to continue? It is something that cannot be said at this moment, but you will have to read the market as the market flows, right? Smart traders wait for retracement into an imbalance, which it has already done, displacement confirmation, and then continuation, or a sweep of yesterday's low, failure to continue, and then reverse, right? We react, we do not assume. So, the execution rules for today: volatility is elevated at this point. Spreads may widen, news may trigger spikes, liquidity grabs will be aggressive. So wait for liquidity, wait for displacement, wait for structure. If price is moving emotionally, step back. Let the market show its hand first. The market will always be there. If you don't get a trade today, you will get a trade tomorrow. The market is not going anywhere, right? That's all for today. Have a nice day. Hope you're profitable today.